But first and foremost, thank you everybody for coming. Really pleased on a cold Tuesday evening that so many people have come. Just 2 house rules. No one's allowed to ask me any questions about regulation or risk because I don't know the answer. There's far better people to answer that. And there's a QR code on the RiskPod planner. That means any deals that happen in this room, 30% to the Unpacking company. So make sure you scan it. So look, first and foremost, thanks everyone for coming. It's a brilliant panel that we've managed to assemble. We're 10 weeks old as a business, so to have you 5 on the panel, thank you so much for joining. Thanks to Sashi for moderating, and at such short notice, and thanks for everyone for attending. I think there's lots of conversations to happen after the panel too that are going to be of interest to everybody here. I wanted to thank Anthony, who's filming me at the moment, who's the co-founder for the RiskPod, who we wouldn't be here without. So thanks for all your hard work and late night chats that we have.
Work related.
All work related, of course. And to clients, to candidates from the recruitment business, and our recruitment company is here. We've got Rob, who runs the recruitment business, who can wave in the middle. Lots of very interesting people here. Our first partners, so Pavel on the front row, who is the CEO, and Wojciech, where are you? At the back, who are a corporate KYC onboarding platform. You should definitely be speaking to them. And there's lots of introductions that we can make throughout. But it's been a pretty turbulent week. We won't spend too long talking about it, but naturally it will probably come up in the panel. So the shameless sell part, just for 2 minutes. Why have we put this on? This is to raise awareness of the RiskPod. So that was there. Thank you. So what is the RiskPod? So we're trying and have started fairly successfully to build the largest community on earth of financial crime and operations professionals. We have started in the crypto space because it's what we know. There's lots of our wonderful clients sat in the room, and there's lots of work to do in the compliance space. Putting a community together is not an easy thing. Takes lots of hard work, lots of conversations. But what we want the RiskPod to be is a community where people have the opportunity to network, for mentorship, for access to opportunities, for training. We are not there yet. We've just started. We've got a long way to go, but we truly believe in the power of what it can do. So these are some of the things that you'll be able to access, which is free, by the way, to join the RiskPod. It's of no charge. Lots more to come, which I shan't talk about now. We can talk about it afterwards. Next one, please. So, how does it work? In theory, it will manage itself. At the upper echelons of the RiskPod, we have captains of industry. These are CEOs, chief revenue officers from crypto, payments, financial services, investment banking, like an expert network, if you will, that we can call upon very, very quickly to offer advice to clients, pan-industry. We've started in crypto because that's what we've been doing, but this applies to digital banking, it applies to payments, commercial real estate. The world truly is our oyster, and for anyone at any level. You know, this is all the way from analysts up to partner level. You know, there's a lot of work out there, and we're doing quite a bit of it. So watch this space and get in touch with us if you're not part of the RiskPod already. Some of the things we offer: KYC, transaction monitoring, outsourcing, and surge support. You know, MLRO and CCO outsourcing. We're very fortunate to have some very, very smart people, of which I can see some of them in the room, who have taken many companies through registration, through various licensing, not just in the UK, but all over. We have people on the ground in about 7 or 8 countries at the moment, taking people through registration for payment, VASP, and various other licenses. And we have a number of strategic partnerships with payments providers and others. And again, we're only 10 weeks in, so lots more to follow, but we have a raft of referrals coming from companies who want to onboard clients to transact with them, where their risk and compliance policies, frameworks and procedures aren't quite there yet. The risk pod solves that problem for them. I'm not going to talk to that one.
Fair enough.
Yeah, that's it. I don't want to talk for too long. What I wanted to introduce, who I wanted to introduce next is Nick, who we're delighted to have join us, not just for the panel, but also as an advisory board member as of today. So thank you, Nick. Nick has, I'll let you introduce yourself, Nick. You'll do a far better job. Thank you very much.
Nick Charters, late of crypto.com and now part of a risk pod at MWek. I'll be brief and then I'll introduce our moderator. But I had a couple of points, which was kind of why now? Why now is we've had a whole bunch of years of rapid technological advancement, awash with cheap money. It's been that, which is great, but what it's caused is loads and loads of businesses have just abandoned the principles of good business. And we're starting to see that. We've seen it play out over and over again over the last 5-6 months. What that means for the risk and compliance professionals here in this room and everyone else who joins the risk pod is an unprecedented opportunity for you to come to the fore and help steer businesses back into calmer waters, to bring the good practices, good quality clients, good quality business practices. And that's what the risk pod is for. For businesses, it's for mobilising teams of expert risk analysts, for bringing you onboarding expertise, and helping you operate in a regulated environment and deliver regulated financial services. For individuals, it's about community, it's about jobs, it's about mentorship and professional career advancement. And we expect our community of the risk pod to grow and grow and grow to thousands of people. So, tonight's moderator. She has 20 years of experience in global institutional financial services. Her CV is illustrious with names like Goldman Sachs, Merrill Lynch, Symphony, Coinbase, nearly as good as crypto.com. She has been recognised for excellence as a woman in finance and as a board member for all sorts of things. But before I introduce her any further, I'd just like to say welcome. You are now all founding members of the Risk Pod. Sashi Dias.
Thank you.
Thank you.
Mark, Nick, thanks for the intro. I'm just going to wait for the panelists to get settled. But wanted to just really thank everyone in the audience for joining us today. And we brought this group together to really talk about firm preparedness as it relates to impending regulation, some of the multi-jurisdictional policies that are going to come to market, and also as we think about some of the current macro and investment trends that we're experiencing right now. And we brought this amazing panel together to talk about the regulatory landscape through the lens of industry professionals. So those professionals are coming from some of the largest crypto market data organizations, liquidity providers, legal organizations, sustainable finance. And I think we've spent a lot of time together just talking about what are the perspectives that we want to share with you that are really going to add value to this conversation today, but how to achieve best-in-class readiness, everything Mark and Nick were really alluding to earlier, across the entire business life cycle, from onboarding to transactional readiness as you think about your businesses. And then a healthy discussion around the disconnects that are currently present in the market, and there's many of those, I think everybody can agree. So I want to take the opportunity now to introduce the panelists, but actually turn it over to the panelists and give a minute or two on their biographies. So I'll start with these.
Stephen Nash, I'm the European Chief Compliance Officer and Money Laundering Reporting Officer for B2C2. I made the transition from TradFi into crypto about 12 months ago, having been an independent consultant for 3 or 4 years before that, and prior to that I worked for illustrious names like Morgan Stanley and Nomura and Barcap and places like that. So that's my career in a nutshell.
I'm Rosie Donachie. I was until January at crypto.com as head of sustainability, where I had a major focus on the regulatory side of sustainability, specifically in digital assets. Prior to that, I was head of regulatory strategy at London Stock Exchange Group, and my background prior to that was in the European Union and in central government in the UK.
Steve Hewson, I've been in the IT industry over 30 years now, God forbid. Last 13 or so within the fintech industry and the last 12 months in crypto. I also come from the trade fi side. Background is designing and building low latency trading platforms for 9 out of 10 of the top tier 1 investment banks. So bring a reasonable amount of experience in terms of some of those stresses and strains that we went through at the back end of the last decade to meet compliance requirements driven from the 2008 events.
So John Salmon, I'm a partner at Hogan Lovells, which is a global law firm, for those of you who don't know. I have been a lawyer also for more than 30 years, which is like a bloody sentence, you know, it's much worse than being an IT person. I left university with a very firm view that I wouldn't be a lawyer, but there you go. Predicting the future is not something that's easy. Anyway, I lead our global digital assets team at Hogan Lovells. My background is actually as a technology digital lawyer. I got the fintech bug about 23 years ago when I did my first big project for a financial service company. I've been doing fintech stuff ever since, and been looking at crypto for the last 8 years, and been at Hogan Lovells 7 years.
Fantastic.
Sorry, I work for Crypto Compare as well. Market data.
and also, can we use the mic just for the people at the back? Is that okay?
Yeah, we can, absolutely. We're going to have to pass it back and forth if you can be patient with us.
To
I
the
don't know,
side.
is it on?
I think it's on.
Yeah, it's on. Yeah.
Sorry about that.
That's all right.
Can you hear us better?
Oh, yeah.
Okay, sorry about that. So we'll dig into the first few questions, and actually the first question I'm going to direct to Rosie. So as we think about the regulatory landscape today, there's a lot of focus on regulatory licensing, implementation of regulations such as MiCA in the EU that was adopted last year, but ESG continues to remain a topic of focus. So wanted to hear how you're thinking about that as a focus globally, and what are the trends here? So what are you seeing from institutional investors and how they're thinking about ESG and as it relates to digital assets right now?
Thank you. So yeah, I think as many people here will know, particularly those who've worked in traditional finance, there has for a number of years been a focus in buy side and sell side, particularly in buy side, on ESG, and focus the regulatory side on passive funds. When ESG is broad, but I mean for the purposes of this topic, I think the EBIT looms largest. It's the easiest to quantify in terms of carbon. So as crypto tokens have evolved, and I think it's fair to say regulators are able to apply ESG metrics to this new asset class insofar as the energy use and associated carbon footprint of, for example, mining of Bitcoin is probably one of the easiest things to quantify in a broader sort of landscape of the challenges of regulating a new asset class and all that brings with it. So what they have done so far and what we've seen, particularly in the MiCA regulation, which you already referenced, reference to the energy use in the sector. Likewise, only a year ago, European Parliament seeking to outright ban Bitcoin mining in a compromise whereby digital assets will come in scope of the EU taxonomy, and it's now passed to the European Securities Regulator, ESMA, to think about the taxonomy. So I think what I would say from that, Europe is blazing a trail. It's set a quasi-precedent, although it's not yet fully baked. You asked, by extension, I think the UK, what we're seeing at the FCA, naturally there's been a big focus on ESG, TCFD, and again it's some kind of application, not necessarily of existing regulation, but to bring new asset class into the fold. The interesting piece of the equation is ESG is far more politicized in the US, but what we have seen last year in Biden's executive order on crypto assets is a mandate to the US Office of Science Technology Policy to assess the footprint and think about solutions. No question of an outright ban of Bitcoin mining, but to look at some of the solutions. So they might be, for example, increasing the amount of renewables in the mix for Bitcoin mining, transparency, disclosure, all of the normal tools that we would see in TradFi. So just to conclude, you asked about institutional investors. I think that one major driver is regulatory, and I think the institutional investor appetite for transparency around ESG issues in this new asset class is there. It's probably not looming as large as, for example, interest in that for fossil fuel companies, but it's certainly part of the conversation from certainly the ones I have had. And that's because I think for any asset manager now, all of the touch points of regulation, be it in the US, EU, UK, you name it, you have to be able to demonstrate alignment with, passive funds being purportedly ESG and holding cryptocurrency, adoption of cryptocurrency, and that's where the interest is coming from. But I'd say the primary driver for change comes from the regulatory side, but of course they're interchangeable, and asset managers, sell side, buy side, take their lead from the regulators too.
Thank you. I actually have a follow-on to that, which I think which is interconnected. So you mentioned sort of the focus of institutional investors, and especially here in Europe. And I think there's been a bit of a differentiation of what we're seeing in institutions engage in, let's say, Americas, around the way that they're getting involved with digital assets versus here in Europe. And one of the topics that continues to come up, at least in the conversations I've been having with institutions, is tokenization of real world assets. So linking your ESG comments around there. So what are you seeing there in terms of how firms are preparing themselves for wanting to be involved in digital assets, but maintaining the integrity of their investment policies around ESG, and how tokenization plays a role there, whether that's linked to solar panel investments or wind farm investments, those kinds of things?
Yeah. So I think one of the interesting innovations in digital assets, crypto, is the tokenization of carbon offsets. So you often hear, probably less so at the moment given the market, but certainly last year, this notion of crypto for good, and that's something the regulators want to hear more about for sure. And so what I would say there is you've seen innovation that actually comes out of the US, for example, bringing carbon offsets on chain, which solves for the sort of current challenges with carbon offsets, namely, you get greater price transparency, e.g. if you're buying an offset, where does it go to the end project, reforestation, renewables, be that what it is. It also solves the problem of multiple brokers taking a cut, naturally, in the current status quo carbon offsetting market. So the venture capital firm A16Z in the United States is backing a project. It's called the Goddess Nature Token, actually, and it's a female-founded firm that's actually brought carbon offsets on chain to solve some of those problems in the existing market, and that's a proof point, if you like, of crypto for good, tokenization of offsets. So that would be, I guess, one example of that.
That's great. Thank you for that. So very insightful. So wanted to pivot to another perspective, and Stephen Nash. I have to do last names because we have two Stevens on the panel. So 2022, quite the roller coaster for all of us, and a challenging year for crypto. I think everyone can agree there. And amidst the FTX debacle and fallout and some of the recent events, even of this weekend, market volatility, another continued challenge we're facing is the non-harmonization of regulation in EMEA and also across the globe. And so while we have MiCA impending for next year, how should the industry think about improving its controls in general? We'd love to hear your point of view.
Well, as an ex-TradFi person, I would say this, but I genuinely believe it. I think the crypto industry, crypto assets in general, needs to learn a little bit from the TradFi world. It went through its own, crypto winter, otherwise known as the global financial crisis, and had to learn from that, both from a prudential perspective and also from a conduct perspective. So I think the reality is the crypto sector needs to look at that, learn from it, and get ahead of it. And don't be afraid of it. The thing to remember is that regulation is, in fact, it is a cost, but it's also an advantage. So it allows you to get ahead of and make sure you've got appropriate controls in place, but it also acts as a barrier to other people that want to perhaps enter the industry. So embrace it, prepare for it, and get ahead of it. And don't wait for the regulator to tell you what you've got to do. So if I think about MiCA, if you think about the HMT Treasury proposals, they're not dissimilar to MiFID and MAR and EMIR and such like. It's hard, but it's not conceptually difficult. So as long as you think ahead and think about what you need to do, both from a good governance perspective and then to prepare for the regulations when they come, then you'll be in a good place. Honestly, there are some parallels there. I do think, as I say, crypto can learn from TradFi. And back to firms like the ones you mentioned and some of the others that we haven't mentioned, and I won't be legal entity specific, but it does tie in a little bit with something I think Nick said earlier on. These firms, they perhaps weren't run very well. There was a bit of a cult of personality in some of these firms. The kings of the hill, they knew what they were doing and couldn't be challenged. So I was actually at some training on Friday, and the phrase that was used was sort of diversity of thought is welcome. So I'd encourage all sorts of firms in this space to embrace diversity of thought, be prepared to listen to the dissenting voice in the room. They're not being a pain in the backside for fun. They're doing it to try and ensure a good outcome. As long as that takes place, and as long as you respond to that and you get ahead of it and prepare for the regulation in advance of it coming, then when it does come, you will be in a position to take advantage of that regulated status.
Thanks, Stephen. So John, would love to turn gears over to you, given your legal background. Well, what advice would you share with this audience in order to prepare now to be ready for future state of digital assets? And are there specific regulatory trends you'd like to highlight for the group so they can get better prepared for planning and where they should be spending their time to plan? Thank you.
Sure, and as previously indicated, future prediction is difficult, but I think with regulations a bit more simple. We've talked about MiCA a few times, talked about UK HMT proposals. I think 2023 we're not going to see anything significant in terms of implementation. MiCA is a mess, frankly. It's already massively delayed. We haven't even got it published in the official journal because they can't translate it because it's so complicated. Not a great start in my view. So 3 years ago I was very enthusiastic about MiCA. I've got less enthusiastic as time's gone by, to be honest. There are 179 proposed delegated acts under MiCA. So that's going to be fun. There are going to be, MiCA's, we've still got to get it translated, it's still going to be published in an official journal, and then it's got 18 months before it actually is implemented. And for those that have been through MiFID 2, PSD2, etc., will know that EBA and ESMA are supposed to produce all these delegated pieces of legislation. I have no faith that they will manage to do it before it's actually due to be implemented, right? It'll be like PSD2, where the only really important RTS wasn't actually available by the time PSD2 was supposed to be implemented. So I think we have a challenge there, and I think that's going to make it very difficult for people in this room when you've got an uncertain regulatory environment, and I think that's what we're facing probably at least until next year, and possibly to the next year after that. The US, the good thing is the US is even bigger of a mess, right? Because you've got Gary Gensler going around making videos about stakes, but not doing anything terribly useful. And I think that our HQs are Washington and London, but we've got a very big presence in the US, and it is, I think, very difficult in the US. There's lots of investigations. This year we're going to see a huge amount more of that, and I think that's going to put a lot of pressure on it, and I just think there's no willingness to engage with the industry. There is an opportunity in the UK. HMT's proposals are broadly sensible. Very difficult to know what that will actually mean. The mood music is we might do something similar to MiCA. Obviously they'll have to say it's different, because certainly in the current political environment one would have thought. So it'll be very interesting to see what comes out. I think there is, the point you made about homogeny of regulation across the world, I've been saying for years, wouldn't it be nice if we all had some homogeny of legislation for digital assets? again, unfortunately, I've been told that that's a naive viewpoint, and we're never going to get it. And I think part of the challenge is, you have cultural norms, right, which means that the US are never going to do what Europe does, or now the UK is not going to do what Europe does for different reasons. So you will have, and I think we need to take that into account. I mean, I think FATF has driven global standards in AML and KYC, which is good. We've now got broadly aligned, although different. We've got vast regimes everywhere that, albeit they are implemented slightly differently. But other than, and interestingly, they've managed to get tax more or less sorted, because guess what, governments can figure out how to get money out of us. But I think other than that, I think it's going to be a challenge for any homogeny, even in the longer term. And I think we're, unfortunately, it's going to be lots of work for us to do, right? But it is certainly, the world is going to look very different in digital asset space in 2024, 2025. There's going to be a huge amount more regulation, and for sure we're going to have to prepare for it. Does that answer your question?
Yeah, thank you. Thanks so much.
So Stephen Hewson, question next one for you. So we were talking the other day about the service provider ecosystem, and it's quite vast and growing in this space in general, just globally. So we're thinking through, like, with the anticipated regulation that's coming, how will these firms have to pivot in terms of planning their roadmaps? How will they adapt their products and services in order to comply with the pending regulations that we anticipate are coming? So would love to get your perspective, given your experience. How can they do that, effectively, and even given there are some knowns and unknowns out there.
Thank you.
Thank you very much. Yeah, this is a really big topic, and I'm not quite sure which angle to start from, but I think the backdrop is, if we just accept the facts, there are a number of givens here. The whole financial trading, monetary systems, banking systems have been in place for hundreds of years. I'm not going to say when it first started, but as a structured industry, it's been there a long time. Crypto has been a very short time. So, let's not kick ourselves. This is going relatively fast. We say it's going to be slow. It's relatively fast in terms of how you compare it to what's happened so far. I think from where we were only a few years ago, I was a relatively crypto skeptic until not too recent past. But some of the shocks that have hit the industry in the last 12 months, I've probably got to the point now where crypto and DLT technology and the opportunities that brings to the whole sector of finance, it's here to stay. I think a lot of people can understand the opportunity of it, and if it was going to get blown away, it probably would have happened by now. And it is here to stay, and the opportunity is massively there to deliver on, but it's going to take some time. I think we've then, in the latter part of the last decade, we watched the whole TradeFi world go through delivering and implementing some really painful to achieve regulations, and I'm now talking about the likes of MWek 2. I worked with several large investment banks whilst we actually upgraded their systems and platforms just to deliver that. It got extended and extended and extended, and it's not easy to do. I think there are mistakes that could be made there, that if we try to replicate that exactly, the cost of entry to doing that is actually going to force the only players that can participate in the market to be the likes of the Deutsche Banks, the HSBCs and the Barclays. So we're kind of like semi-defeating the whole purpose of what we're trying to do in the first place. So I hope and expect that there will be, apart from the concept of proportionality in regulation, there will be some step back for that to make sure common sense happens. So given that, but then given the conclusion that if we also do see it as a major transformation, then it's also is going to attract quite a lot of new regulation. It's going to extend regulation. And I suspect that it's probably going to go along the lines of what we've actually witnessed in the TradeFi world. Maybe not be exactly the same, maybe watered down for certain things, or watered down for certain things, or whatever, or things we've actually learned, but it is going to go in the same direction. So there are some no-brainers in this, and it's also good practice. You know, I'm an engineer, it's good engineering practice. People will do business with you if they trust your practice in your process. They're not actually going to do business with you if you actually think you're a fly-by-night organisation that is really going to screw it all up. So a lot of this is common sense. A lot of it will actually win you business, but it will come. So, and I'm now actually talking about, and I think good examples here might be exchanges. If I just use that as one example, it's one example of many I could choose. I know we do have some reps from exchanges in here today, but most of the exchanges we deal with, we collect data from about 200, this is where I get actually like pushing for the organisation for what I can sell now. we collect data from about 280 exchanges, crypto exchanges around the world, and we actually create product from that. The vast majority of those exchanges push out data was absolutely awful, which would actually not be viable for any form of structured or investment grade product. And then you've actually got a smaller few who actually do achieve that, but actually still not. They still wouldn't be good enough to actually pass the MiFID II test. So what we are going to need is a much more precision level of engineering. They're all web native. None of the other exchanges really, no, in fact, none of the other exchanges in the TradeFi world are web native. Web native platform and technology introduces new problems, new issues, accuracy, dropping packets, messages, things you can't do in the TradeFi world. So there's going to be a big evolution from the cloud. Cloud has enabled the industry to get so far. Now, I'm not quite sure whether cloud hosting certain platforms is viable in the future unless the cloud players actually are able to engineer their platforms for exchanges equivalently. So I think there is one area. And then obviously there's other types of regulation. I was reading up on DORA recently. That kind of like reminds me of school. We had Mitty, DORA, the bug explorer. And you know, there's a whole bunch of stuff in there in terms of resiliency, availability, uptimes, things that don't exist within the crypto or digital asset world necessarily today, or perhaps things that aren't mandated. I don't think you necessarily have to invest massively from a capital perspective, but I think getting the foundations and the basis of how things are engineered, dotting the I's, crossing the T's, and how those business processes work, how you can evidence the fact that certain conditions are met and records are kept. Sounds really painful, it sounds really dull, and kind of like it's as painful as you allow it to be. And yes, it is quite dull. I'm not going to say anything different to that. I think it will have to be done, and we only need to move the dial a small amount, and that will attract, you know, the rest of institutional money to drift into the space. And before you know it, the scale of the business that we're looking at today is going to be fivefold before we know it.
Thank you. So would like to pivot to another topic. I know that's near and dear, Rosie, to your heart, and we talked about this the other day. So the FCA and global regulators are looking further at gender diversity in digital assets, and as they do for other asset classes, as they should. So how do you feel that data should be assessed there, and how should we think about affecting change for greater diversity in digital assets?
Yeah, so I think this, as you say, is on the radar of many global regulators. I think that the two that stand out really are domestically in the UK and in the United States. So in the US, the House Financial Services Committee has got a subcommittee on diversity and inclusion, and they are looking at a range of so-called strands of diversity within this new asset class, in the same way as they would, as you mentioned, for on the buy side and on the sell side. And particularly on the sell side, D&I typically has been approached in the US, UK and the EU through a lens of risk, groupthink, diversity of thought, unconscious bias. So it's not just for the sort of, you know, the sort of so-called moral case. So as recently as September last year, crypto exchanges, venture capital in this area, private equity in this area were asked about diversity and inclusion. And I think to the point about data, because let's say the majority of the ecosystem is not publicly listed, neither is it sort of got a very mature approach, meaning it hasn't been around for that long, isn't steeped in what TradFi would be used to, particularly listed TradFi in terms of transparency, disclosure, quantifying. So CASPs and others were required to give that data insofar as it existed, very patchy data sets on gender, ethnicity, disability, and actually a very mixed picture emerged because of the sort of finished data sets. No surprises and gender was the one people had most insight into, most data on. No surprises, not the most diverse new asset class. Interestingly, for some of the CASPs, not that far behind TradFi, however. Obviously you have in the UK ambitions such as HMC's Women in Finance Charter, which is 40%, and I think some of the CASPs, the crypto asset service providers, averaged around 30%. So not that far behind, but certainly not a beacon of diversity. Likewise, FCA, it's got a new head of ESG. It's one of the areas that is again easier to quantify. So all that to say is there's no reason why a new asset class should not have equal treatment to how the rest of traditional finance shows up on this topic. It's not that hard to run the numbers, particularly on gender. You don't face the same sort of data set or kind of actual legal issues. For example, in France, it's prohibited to collect data on the grounds of ethnicity. So, in that way, by the same token, coming back to institutional investors, that matters too, and they view it through the risk prism. Is there enough diversity of thought? And hence that's on the radar. No regulatory lever is yet being mooted in any jurisdiction, but it's safe to say, I think, notwithstanding whatever happens in the US politically, here or in the EU, I think it will remain on the radar. One final point, if I may. I think one of the interesting things to note is, and it's similar to other industries, is the so-called pipeline issue. So, for functional roles, be it legal, be it my kind of role, finance, etc., you don't necessarily have to have come through the ranks, know how to code, be an engineer. But for those working in the sort of the underpinning technologies, engineering, etc., maths are a prerequisite, and so the so-called pipeline issue, there are fewer women and girls taking those subjects. So I think what is interesting, and you see more and more of, is some CASPs and others in the ecosystem partnering with Imperial or with Cambridge and similar in the United States to actually sort of so-called, reach out and help stock a more diverse pipeline. And in the US, really interesting initiatives, not just on gender, women and girls, but also on ethnic minority communities.
Thank you. So those were all of our prepared questions. We have some time to take questions from the audience if there are some. And I think one topic that I know is on folks' minds probably from the events of last weekend. So we could go around also the panel to kind of talk about perspectives just generally there. I think one of the things to talk through is, obviously everyone knows we witnessed both in the US, the Fed and FDIC kind of taking decisive actions to protect the US economy, and then here we saw in the UK HSBC taking over SVB's UK entity. So I think some of the things we were kind of pondering around is, would lending in general become more aligned with traditional regulatory requirements, and sort of how that could impact us here locally. But I don't know if any of the panelists have anything generally to add around the events, preparedness, just more generally. John, you've been all over this all weekend.
Sure. I had literally 500 emails over the weekend on this. I think it is horrible, catastrophic thing to happen to Silicon Valley Bank, but the big impact really is thousands, both in the UK and and in the US, of tech companies unable to have a bank account, until they got rescued. So great on HSBC for doing this, and but I think it's all the interconnectedness, because if I look at I think you make a really good point about DORA, because DORA does apply to CASPs, right? So because at the moment, if you're a bank, you've got the EBA outsourcing guidelines, so you have to have a particular type of contract with any outsourced service provider, but that is going to be massively increased to all ICT service provision, and will be expanded massively to CASPs and etc. So there's a whole fintechs basically in a huge way, but it also goes from outsourcing to all ICT service provision. So it's a huge deal for, again, everyone in this room. Sorry, coming back to Silicon Valley Bank, and there is a connection. Honestly, I'm not wittering on, but Silicon Valley Bank, because of the interconnectedness now, I had lots of inbound emails from really big global banks saying our system is provided to do AML KYC, or I won't name the various functions, but big functions that are utterly critical, and where the staff going to be in on Monday because they knew they couldn't get paid because the company they worked for had a bank account with Silicon Valley Bank and they couldn't pay them. And guess what? In the contracts that I draft, I don't generally say one of the events of termination is the provider's bank going bust. That's not one of the things that we generally think about. So it's all of these things matter, right? And I think it is great that the government and the UK stepped in, and US similarly, and we are protected. But it just shows how fragile some of this is. But I think the good thing is, and this has been said quite a lot in some literature I've been reading, is broadly the bank regulations that were dreamt up in the last financial crisis sort of worked. All the bank bailouts, it did work, and the government was able, because there is a whole recovery and resolution system, so it did work. So I think that's a good thing, but I think the governments in both countries reacted well and quickly, and rescued, probably, because we would have had 20 years of nonsense, or at least 10, right, if this hadn't happened. Maybe another Lehman's.
Just sort of building on that, I think probably early signs, it's a vindication of liquidity ratios, EU regulation. I don't think that's maybe spoken about enough. And ultimately, I think that, as John just mentioned, the intervention of central bankers, policymakers, HSBC, it has stemmed contagion to cryptos. I think one could conclude crypto has been saved by this weekend's intervention. Because maybe some don't want to sort of see it in those lights, but I think it's safe to say that that's certainly my view.
That's interesting.
Can I just add to that? So that's an example of what I was talking about earlier on, which actually regulation can actually help firms stay solvent. Well, not in these cases, but certainly those banks that went under didn't. But the regulation is not there to stop to prevent bankruptcies. It's to prevent the contagion and to allow the orderly unwind of these firms. And again, I share the view that the regulation arguably worked. What we don't see is what would have happened if the regulation hadn't been put into effect. I suspect there would have been dozens of other bankruptcies in the last 15 years had it not been for this regulation, but we'll never see that because it never happened. And again, the contagion hasn't happened, certainly not yet. And on a slightly sort of facetious note, I'm glad it's the banking sector, not the crypto sector, that's getting the headlines right now. That's all.
Although, I saw someone leaving crypto for Silicon Valley Bank. There was everyone.
Oh, hang on. Can I just add to that? So actually, I'm going to throw TradFi under the bus a little bit now. I think part of the problem that the crypto sector faces is that many of the big banks don't want to deal with crypto. Now, what that results in is the crypto firms dealing with a smaller number of banks, and that results in the concentration that in turn perhaps contributed to the situation that took place over the weekend. So I think somehow we need to bridge the gap between crypto and TradFi and make sure there's in fact more connectivity and more dispersion of risk rather than reducing that connectivity and concentrating the risk. That's what I try to encourage the regulators to do, TradFi to do, and also crypto to be welcome to. But in turn, crypto as a sector, I think probably, if it looks at what happened in its own backyard, needs to probably improve its own controls to allow the banks to then welcome them into a sort of level playing field.
Totally agree with that, and I don't know if anybody else knows this in the room, but in France, in France there is a voluntary law in crypto which has been there for the last couple of years, and if you comply with this in voluntary law, then you have to be given a bank account by the banks. Now, Nick and I were part of the AC Crypto Sprint, which was a fun thing last year, and actually that was the point that we made on DeFi, is actually you could have some sort of voluntary regime, but there would have to be a quid pro quo, which would be things like bank account, right? So totally, completely agree with your point.
I have a question in relation to this. So, in terms of the reaction and intervention of, let's say, HSBC, the government in the UK, was that as a result of prescribed regulation, or was it as a result of the government knowing the number because it's been there before?
So, it's a bit of both, right? The regime exists for recovery and resolution of the bank, but obviously selling it to HSBC for £1 didn't exist. But there were, HMT and Bank of England, etc., knew that if they didn't have a rescue package, the orderly winding up of the bank would have been done, but it would have been an absolute travesty in the meantime, right? Because you wouldn't, the Bank of England would have had to do something like spin up temporary accounts, you'd have had to figure out how people got their money, etc. So I think it would have been really very, because although in theory it's there, so I think, I don't know personally how obviously it all came to pass, but the fact that HSBC bought it, I'm sure the UK government went to a number of banks and said, please buy this, and someone did, right? Because, and I know from various messages and emails, etc., over the weekend, you had people like Innovate Finance and the other trade bodies, very worried about what it was going to mean to the tech industry, and I think it would have had a huge impact for not just for days, weeks, but years, had it not been rescued.
No, I think it's great. I'm just wondering whether it was a regulatory or a...
No, there's no regulation says,
you
can't, but there is that kind of orderly wind down, right? And
I think there's a question over here. Sure.
I think all valid points, by the way, and I'm coming from having helped unwind Lehman Brothers, Northern Rock and Brothers in the past, and then built the systems at Celsius to trade crypto for the last 2 years. I've ummed and ahed about this topic, as everyone has, and the topic of moral hazard hasn't really come up in this conversation. There was a systemic risk in 2008 to Main Street not being able to pay people, etc. Arguably, some very wealthy venture capitalists would have got a 10 to 15% haircut, and some companies that were taking risk would have failed. We now have a situation where people who are wealthy in society are taking risks, failing, and the people who are paying are the increased fees in the funds that effectively insure all of this. And I wonder what the panel thought about that. And secondly, I'd say KPMG signed off Silicon Valley bank accounts, their audit February 28th. In terms of risk and reg, that's one of the many things we have in regulation that's meant to stop and be a backstop. And what do they think about that as an existing 3 lines of defence rule that completely doesn't work, where crypto could actually do something from a transparency perspective a little bit better.
Who's taking that one?
It's a hand grenade.
I'll start. I'm not going to comment on KPMG because it's not fair. But it's too easy, isn't it? The moral hazard one, I get it. It's interesting, but I received messages. I'm sure many of you did as well on Twitter from startups.
Oh yeah,
single mother in the US. This was her. This was her bank account. How was she going to pay staff? Rates read on Monday.
It's a difficult question, but that's not the single mother on food stamps.
Yeah.
Right? And that's what you're comparing it to.
No, but it's still it still would have a huge
Agreed.
impact. Someone that's started a company X years ago and then is
I think that if we're looking to have a flourishing startup tech community, we need banks like Silicon Valley Bank, and it needed to be rescued. Just in the same way that some of the banks in the UK need to be rescued. In 2008.
I'd say by Friday there'll be no money left in Silicon Valley Bank in the US. Easily.
We'll find out. Is there anybody else?
I agree with most of what you said, but I think the relevance of this is kind of actually it had to happen in terms of the bailout, otherwise it could have been, or the intervention, otherwise it would have been a lot worse. I think the actual failings that had nothing to do with crypto. Couldn't quite hear whether you actually suggested it wasn't, because obviously, but there are regulations that should have stopped the bank having, I think it's FRTB, they should have understood what the risk was on the book to actually get to that point. If you've seen what's happened to the crypto price over the last 2 or 3 days, is that a reaction to actually go, Drake fire, let's go and put everything in crypto again? And I suspect that, some of the benefits we get from DLT and smart contracts will be the things that make the transparency enabled that will be the future to stop these kind of events happening. We'll never eliminate them, but it actually could be a very constructive way of doing that, because then you can expose them in a more transparent way that it gives exposure to risk profiles. Open source banking.
Thank you. Well, thanks for the question. We're actually at time for the panel. We're going to take additional questions. We can approach the panelists in the networking session, but I want to thank Mark and the MWek team for hosting and bringing us all together tonight, the panelists for your insights, and all of your responses, really insightful, and your contributions, and wanted to add that this is going to be the first of a series that MWek's going to be putting on, so I'm sure you'll hear from Mark and his organization. So if you want to get in touch with us, we're going to be, a bunch of us will be at the networking event. You can reach out to us on LinkedIn for any follow-up questions, and obviously to Mark and the MWek organization, solutions at MWekSolutions.com if you have any questions regarding the risk pod or anything relating to the event. So I want to say thank you on behalf of everybody here, and appreciate you joining us this evening.